Venezuela's history of defaulting on its debt 11 times in the last century has always served as a warning about systemic risk in emerging markets. But this weekend, that risk materialized in the most dramatic way possible. A U.S. military operation captured President Nicolas Maduro, who now faces federal drug trafficking charges in New York. What once looked like opportunity unraveled through political instability, excessive borrowing, economic collapse, and now regime change. For retirees, this story underscores how quickly global risk can move from theoretical to catastrophic.
Welcome to Leibel on Fire with Amazon best-selling author and Yields for You portfolio manager, Leibel Sternbach. Leibel on Fire is supported by our ETFs, Yields for You Strategy A and Relative Strength Managed Volatility. Our mission is to help 1 million people retire with financial security. Now, the Financial Independence and Retirement Show dedicated to helping you build the life of your dreams as fast as possible with as little stress as possible. It's Leibel on Fire.
Let's just jump right into this, Leibel, if you don't mind. What does Maduro's capture tell us about geopolitical risk and how fast, stable investments can become worthless in a matter of hours?
Yeah, so the thing that as portfolio managers, as investment advisors, as traders, as people who pick securities and make bets in the long run, we have to, one of the things we always got to keep in mind is we got to really understand what it is that we're investing in and what are the unique risks associated with the thing we're investing in. And, for the most part, we're kind of used to investing in the United States stock market, right? Or in the global markets, where we're talking about, countries that have long history, that have stability, that, they enforce their laws for the most part, right? And you're not so worried that they're going to come in and they're going to privatize, IBM, right? Or Microsoft, right? We're not worried that the government's going to come and shut down a major corporation. That's not usually a threat. We're also not really so afraid that a company is going to manufacture something and there's corporate espionage, right? Or that there's bribery or there's corruption, right? These aren't things that we worry about on a daily basis. But as we start going into less developed economies, right, or where the rule of law is not is subject to change or interpretation, and then all of a sudden we start having those risks. What happens when the government decides we're not paying back its investors, or what happens when the government decides we're going to nationalize private businesses for the greater good? And what Maduro's capture really shows us and highlights us is that these assumptions that we have about the world we live in, right, they can be upset in an instant, right? All it takes is one person, right, with the right power to say, the status quo is no longer the status quo. And sometimes it's not even a decision that people make, right? We don't have to look that far back to COVID, where we had, it was a virus came and completely transformed the way that the world operated. It completely changed the way that, goods got shipped around the world. It was a wake-up call to every manufacturer that they couldn't keep, relying on just-in-time manufacturing, something that had become the hallmark of for the last 40 years of manufacturing in the developed world, right? And so there's always something that comes along. There is always a something. There's always the next something that comes along and changes and shakes up the status quo. Right now, for Venezuela, for emerging markets, for dictatorships, right, that wake-up call was that Trump decided, hey, you know what, we're going to send in law enforcement, special forces, and a tiny fraction of the United States, air power, which is, completely swamps almost every other country's air power. And we're going to just take their sitting, head of state and bring him for trial, right, which is something that hasn't been done in a very, very long time, right?
Been a while. It's been a while. I'm just curious, at the open, we talked about Venezuela's wealth having defaulted 11 times in the last 100 years. What does that history reveal to you, Leibel, as it concerns systemic risk in these emerging markets?
It's so you would think, right? And I just want you to put yourself in the shoes of the government, right? Like you're an investor, right? You're Citibank, you're Morgan Stanley, right? These are the banks that underwrite these bonds, right? They're the ones who go out to investors and say, hey, Venezuela is looking to build a bridge. Right. They're looking to fund their, welfare program, their social security program, their whatever. Right. They need, $20 trillion or whatever. And we're selling bonds. They're going to pay it at, 10%, 15%, 20% returns. And they're selling that the government is going to be there, but the debts are going to get repaid. And the first time that they default on it and they say, the government says, we're no longer paying back those debts, or they come back to the negotiating table and they say, we agreed to pay, 15%, but we're only going to pay you 7% on your interest on your bonds. And the first time you go, okay, well, then we're not going to loan you any more money, right? Or if we're going to loan you money, we're going to loan it at sharp, loan shark rates, right? 25%, 50% interest, right? And we're going to calculate it daily. Right? At what point do you go, well, you know what? This is the 10th time you do it. This is the 11th time you've done it. We'll still do it, right? But that is the world we live in. And it is kind of is eerily similar to what happened with the Great Recession, with the housing market collapse, right? Why was the housing market able to balloon the way it did? Why was it able to collapse, right? It was all because the people who were giving out the money had no financial repercussions for giving out that money, right? Banks were incentivized. They would give out loans and then they would repackage and sell it to the government, who would then repackage it and sell it to Wall Street, and then would get repackaged into a million little pieces, right? And no one involved in any step of those transactions had a long-term financial risk to the outcome. So what did they care whether the person can pay back the debt or not, right? And that is what happens with this emerging market debt is, well, the people who are issuing the debt, right, Morgan Stanley, Citi, whoever, right, they get paid a fee for helping these bonds get sold. So they get paid upfront when the bonds get sold. They don't care whether the bond actually can get repaid or not. They don't care whether the country is solvent or not. What they care about is that they got their commission. And it is something that, just because it's an ETF, just because it's in a mutual fund doesn't mean it's a safe investment. And we're seeing the same thing happen, whether it's with emerging markets, which is no longer the hot issue. Right now, the thing that everyone's talking about is these collateralized loan obligations, which they're essentially these loans that they're giving to companies that ordinarily couldn't get these types of loans from banks. They're going to private lenders. The private lenders are maybe doing underwriting, maybe not. They're issuing huge loans, and then they're repackaging and selling them to bigger issuers, and they're selling them in ETFs and mutual funds and your 401k accounts. And you've got to really ask yourself the question, what is the risk that I'm taking on, right? And you gotta, just kind of, what is it? Warren Buffett, right, and Charlie Munger, would say, right? It's you got to be smart about these things, right? You don't do sophisticated investment transactions, right? That's not other people, younger people who can figure it out and lose their shirt 15 times can do that, but us who can't afford to it and we don't have the brains to figure out all these things, right? You got to make sure does it pass the sniff test, right? Like if you ask your grandmother to put money in it, would she be like, "What the hell are you asking me? What is this thing?"
You don't want to go down that hole.
Yeah.
So speaking of that, you mentioned the currency collapse. Talk about how inflation, currency collapse, and capital controls, like what we've seen in Venezuela so far, threaten reliable retirement income.
Yeah. So what you really have, right, when we talk about retirement income, and we're going to shift gears for a second, right? We've been talking so much about Venezuela, and we're talking about, economies and, these kind of systemic risks that we need to think about. But how does this relate to us as investors, right? How does this relate to us as retirees? Well, the fact is that when we look at and we say, well, I want a 60-40 portfolio, right? I want something that's low risk. I want something that, when the stock market goes down by 20%, it's not going to go down by 20%, right? I want my principal protected. I want to get up. I want to get some upside. And I want something more than what pays for the high yield savings, right? Because high yield savings isn't really paying much these days. So you start looking for more risk, right? Or you go to your Vanguard, right? And you're like, I want a 60-40 portfolio, your Fidelity, right? You get your 60-40 portfolio. Well, how are they getting the returns, right? If you can't go to the bank and get a high yield savings account, and you can't go to the federal government and get more than 4%, where are they getting this more than 4%, right? And you can ask the same question of us, right? Like we have the Yields for You income strategy A, right? It is kind of one of these alternative funds, right? Where we get income from lots of different sources, just like how a Vanguard total income fund does, right? But the question you got to ask is, where are you getting it from and what's the risk you're taking on? And a lot of that, the easy answer that a lot of them have is, oh, well, we go to international markets, right? We go to places where there isn't a premium, or we should say they have to pay a premium to attract dollars, right? Because if you're not the United States, right, well, then you got to pay a little bit more in interest, right? And if you are in Germany, right, you're going to have to pay a little bit more, right? And then you start looking at, well, what if you're India? Well, India's going to pay really well. What if you're Russia and nobody wants to touch you? Well, they're paying over 20% interest on their bonds. Now, do you think Russia's going to default on their bond? I don't know. They did it in the early 90s. So no one thought a sovereign nation would do it. No one thought that a nuclear power would do it. No one thought that the second largest economy in the world would do it, but they did it. And so when it comes to this emerging market debt, there's a lot of, when we talk about the bond, the bond market, fixed income market, a lot of it is coming from this, what we call emerging market. An emerging market just means that they aren't an established economy. They aren't a, United Kingdom, United States, a global power. They are one of these other economies that, well, they have political upheaval, right? They tend to have their heads of state disappear randomly. So.
That's a delicate way of putting it. Do you have anything at yieldsforyou.com that speak to emerging markets and how we can protect our income in retirement?
So we don't, not specifically, because we're not, an emerging market isn't something that I think that we really should go into, right? When you look at the risk reward, that's related to, how much risk am I taking on for how much reward I'm getting, the squeeze isn't worth the juice, right? You're putting on, all your capital is at risk because at any point, right, one of these countries can topple, right? Look what's happening in India. India is probably the most stable emerging market, right? But they're on the verge of civil war almost, right? They're, we talk about them as being a democracy, but inside the country, they're talking about themselves like that they're a dictatorship because that's how they feel, right? Mm-hmm. Rule of law is really the rule of one party, right? And it's not even just one party. It's one, like, they've got like a caste system, and we might, it might have been disassembled a little bit with the democracy, but the fact is that the haves and the haves not they're very old generational lines. And that's what's ruling that country. And when you look at a country like that, and then you say, well, I'm going to loan you money, right, with the expectation I'm going to get my principal back, well, that may not be a safe bet, right? And so when you look at how much premium you're going to get for loaning that money, well, maybe it would be better to invest that money into the United States because it has a lot less risk and a lot more upside than what you're going to get by loaning it to some scammer in India, right, who might run off with his little yoga cult, which if you think I'm making a joke about that, I am not. Go look at the news because that is the largest real estate investor in India is under indictment for that. So,
well, we got to leave it right there. But as Leibel mentioned, I should say that there's not much information on emerging markets at yieldsforyou.com, but there is a wealth of information that you can find just by visiting. We got to leave it right there, Leibel. And I should say this, that Venezuela's history of debt defaults was already a warning that emerging markets risks don't stay overseas. They eventually show up on our shores. Maduro's capture this past weekend proves this point. Political instability, sanctions, and now military intervention can erase values overnight in an instant. For retirees chasing yield or diversification without understanding underlying risk can permanently damage income and damage principal. In retirement, protecting capital and cash flow must always come before reaching for higher returns. I'm Freddie Bell for Leibel on Fire, and join us next time right here.
If you would like to see how the Yields for You team can help you get off the Wall Street roller coaster and save you money on taxes so you can live the life of your dreams, book an appointment online at yieldsforyou.com or call 410-914-4894.
Yields for You is a registered investment advisor in the state of New York and only transacts business in states where the firm is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussion should not be construed as an offer to buy or sell or solicitation of any offer to buy or sell the investments mentioned. Annuity guarantees are subject to the claims paying ability of the issuing insurance company. Content should not be viewed as legal or tax advice. Always consult an attorney or tax professional regarding your specific legal or tax situation.